Do you remember the discussion about the possibility of a technical recession in Australia from the video on our channel 2 weeks ago? The word possibility is no longer relevant because the recession has already happened.
We're officially now in a per capita recession.
Per capita recession.
Australia has entered a per capita recession.
Per capita recession, registering 2 negative quarters of per capita GDP growth.
The Australian economy remains steady and sturdy.
There is nothing steady or sturdy.
According to the latest data released by the Australian Bureau of Statistics, although Australia's GDP rose in the second quarter, GDP per capita declined consecutively in the first and second quarters, meaning the Australian economy has already entered a per capita recession. What's worse is that Australia's productivity has significantly decreased. The economy barely keeps its head above water by relying on immigration and exports. Under such economic pressure, how is Australian property market performing? What will be the future trend, and when will interest rates start to drop? How is Australia coping with the pressure of China's economic downturn? By the end of this video, you will have all the answers. Hi there, my name is Alex. Welcome to my channel where I share information about real estate investment, economic trends, and wealth creation. If you like this video, smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it. A technical recession is generally measured by 2 consecutive quarters of negative GDP growth in a country, meaning the nation's wealth shrinks for 6 months straight. The problem caused by such a recession are severe, often accompanied by high unemployment rates, business closures, debt defaults, stagnation in bank credit, and stock market crashes. Some familiar recessions include the Great Depression in the US in 1929, the 3 oil crises of the 70s and 80s, the internet bubble in the 2000s, and subprime mortgage crisis in 2008. Each of these severely impacted the economy. Australia, however, has been lucky. The last time it faced a recession was between 1990 and 1992 during Paul Keating's era. The GDP dropped by 1.7% then, and the unemployment rate rose to 10.8%. In 1991, both interest rates and unemployment were at historic heights. The recession's impact on Australians was terrifying, with many losing their jobs and surge in business bankruptcies. Surprisingly, during the 2008 global financial crisis, Australia was the only major economy relatively unaffected. Hence, many say Australia, with its long-term stable economic growth, is a lucky country. The measurement for per capita recession, however, is entirely different. If a country's GDP per capita, and note it's per capita, declines for 2 consecutive quarters, it indicates a per capita recession. The latest figures from the Australian Bureau of Statistics reveal that in the first quarter of 2023, Australia's GDP per capita decreased by 0.3%, and as expected, it continued to decline by 0.3% in the second quarter, firmly entering a per capita recession. While Australia's overall GDP has seen a slight increase, the per capita wealth is shrinking, and this per capita includes new immigrants. We've heard too much news about the surge in immigration. There were statistics not long ago suggesting that Australia would welcome 400,000 new immigrants this year. It was believed that increasing immigration would bring substantial wealth to Australia. However, as it appears now, the massive influx of immigrants has placed a significant burden on public and welfare systems, stimulated a rise in housing rents, lowered the average living standards for Australians, and dragged the country down. But on the flip side, without this immigration, would Australia have already entered a technical recession? Not long ago, the Australian federal government released the immigration quota for the fiscal year 2023 and 2024, and the results were jaw-dropping. The state government-sponsored immigration quota for this fiscal year has decreased by 70%, and the business investment immigration quota has been reduced to 0. Not sure if the Australian federal government regrets its immigration quota decisions after seeing the economic report. On the other hand, one of the primary culprits dragging down the Australian economy is its declining productivity. Reports indicate that Australia has seen negative productivity growth for 3 consecutive quarters, with a cumulative decrease of 3.6% over 12 months. This means that if a person produced a value of $100 per hour a year ago, they can now only produce $96.4. In other words, people just can't complete the same amount of work anymore. With productivity declining and GDP slowly growing, it suggests that wealth is either derived from immigration or exports. These 2 economic pillars must remain steady to ensure a soft landing for the economy, as Australia's path to economic prosperity through self-created value seems unfeasible. In his last speech before stepping down last week, the former governor of the Reserve Bank of Australia, also expressed concerns about the Australian economy. Dr. Lowe stated that Australia's productivity has hit its lowest point in the past 7 years. This trend is likely to persist for a while, coupled with wages rising faster than productivity and increased consumer spending. There is too much pressure on inflation, and thus a high inflation and high interest rate environment might persist for a considerable period. While GDP growth is weakening, government welfare spending is on the rise. For instance, the National Disability Insurance Scheme, NDIS, overspends by $32 million daily. Of course, this represents only a fraction of government expenditure, but cumulatively, this fiscal deficit pressure can only be offset through taxation or borrowing. The government has already borrowed too much, leaving taxation as the only viable option, which will further reduce people's living standards. This is what I foresee happening in Australia in the coming years. In September, Australia paused interest rate hikes for the third consecutive time, offering many people a break. Those with loans can breathe a little easier. However, the effects of rate hikes are gradually becoming evident. Australia's unemployment rate has climbed to 3.7%. Although this is still relatively low, the trend is clear. Worsening economic conditions inevitably lead to rising unemployment. The countermeasure would be to reduce interest rates in the future, ease credit restrictions, and stimulate an economy rebound. So when exactly will the rate cuts begin? How will the Australian property market be affected? Will China's weakening economy drag Australia down? And does Australia have any countermeasures in place? We just completed our monthly live stream last Saturday, where we delved into the housing market's performance in August. In short, the Australian property market rebounded in August. After 3 months of slowing growth in housing prices, they began to bounce back and accelerate. The national index rose by 0.8%, with Brisbane leading the surge at 1.5%. Except for Hobart and Canberra, which remained stable, all other cities saw a rise in housing prices. In terms of rent, except for Canberra, which saw a decline, all other cities experienced varying degrees of increase. So at this point, some might wonder, why are housing prices rising despite the recession in Australia? This can be assessed from two perspectives. Currently, although the number of properties listed for sale in August is higher than the same period last year and 5 years average, the stock of the properties on the market, those listed for over a month without being sold, is significantly lower than last year and 5 years average. It indicates that the market is able to absorb the increase in listing. However, as the effect of interest rate hikes become evident, the difference will gradually even out, bringing the market back to a rational balance. The next property boom is likely when interest rates drop next year. As I've mentioned in the previous videos, the fundamental driving forces behind Australia's rising housing prices can be summed up in one phrase: people and leverage. Population growth drives the overall rise in Australian housing prices, and an increase in population in a particular city or region pushes up prices in that area. Factors attracting people include infrastructure, healthcare, schools, transport, future development plans, sunny beaches, and more. These are crucial factors we consider when assisting our VIP members in selecting properties across Australia. The current market aligns with the people element. And the second factor is leverage, which is the financial and credit aspect. High interest rates and credit tightening characterizes the current market. Once market interest rates begin to decline and credit expands, making loans more accessible, housing prices will naturally skyrocket. The future housing market might see a gradual rise followed by a significant surge when interest rates drop. Those hoping for a market decline might be disappointed again. Of course, my educated guess might not be correct. Please don't base your investment decisions solely on my views. After all, if you lose money buying a house, I can't compensate for it. And if you profit, you won't share it with me, right? This people and leverage concept is a highly refined standard for measuring housing market fluctuations derived from our years of market experience. While these principles are understood by many, concerns are inevitable, as worrying is second nature to many people. Recently, a lot of people have started worrying about the impact of China's economy on Australia's economy and housing prices. If you're not yet aware of China's current economic situation, a few numbers will paint the picture. China's imports and exports have plummeted for 4 consecutive months. Foreign direct investment in China has decreased by 85%. GDP growth has significantly slowed. Housing prices have crashed, and the youth unemployment rate is so dismal that it's no longer being reported. Add to this is negative population growth and number of foreigners traveling to China dropping to 1978 levels. All these factors sketch out the current economic predicament in China. Given that Australia has prospered from China's infrastructure demands for Australian minerals and other agricultural products, will Australia be dragged into a technical recession due to China's economic downturn? Well, economists, columnists, and commentators all have their takes. My view is that if Australia doesn't change its mode of cooperation with China, its economy will undoubtedly be affected. However, if it does change, the outcome would be much better. In this context, Western Australia's newly appointed Premier, Roger Cook, has taken a significant step. Just 2 weeks ago, the Premier of Western Australia led a delegation of over 130 business representatives, most of whom are from the mining industry, on a trip to Indonesia to attend the Indonesia Summit. Of course, the primary agenda was to meet with Indonesian President Joko Widodo to discuss potential collaborations in trade, education, and tourism. Many might be confused by this strategic move. Let me clarify. Indonesia is currently the fourth most populous country in the world. Its national economic strategy is to leverage its processing industry's cost advantage and geographical benefits to establish the world's largest lithium battery production base, catering to the green energy trend for the next 30 years. On the other hand, the world's largest hard rock lithium mine is located just a few hours south of Perth in Greenbushes. Australia's unmined lithium reserves are unparalleled globally. Currently, mining in Western Australia accounts for over half of its GSP, with iron ore exports making up 60%, most of which is sold to China. So if a new mineral exports replaces iron ore's position and it's sold to another emerging economy instead of China, wouldn't Western Australia's economy become more stable? That makes sense, right? So for both Australia and the entire country, this is a strategic move. The previous premier relied on China, but the new premier initiated the decoupling process from China upon taking office, making a 180-degree policy shift. If other states can follow suit and find alternative solutions and new export growth points, the impact of China's economic downturn on Australia will be minimal, answering the question I posted earlier. Perth's housing market is entirely different from the three major cities on the east coast, Sydney, Melbourne, and Brisbane. In Perth, when mining industry thrives, the economic does well. A booming economy attracts labor and capital to Perth, leading to a surge in housing prices. Over the past 25 years, Perth housing prices have been directly correlated with the prosperity of the mining industry. I was initially concerned about Perth's economy and housing prices, fearing that the impact of China's downturn. But now, seeing some hope if Western Australia's economy can successfully overcome its dependence on China, a rise in housing prices is just a matter of time. If you made it this far, please give a like, subscribe, and share this video with your friends. Turn on the notification bell and watch new weekly videos. And follow me on social media at RealCoachAlex. Hope to see you soon. Have a good one. Bye-bye.